You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast.
Global markets seem to be holding steady right now, but it feels like this momentary calm is really hiding some major policy waves building underneath.
Especially with President Trump's announcement expected today, right? And all those central bank decisions lined up globally.
Exactly. And it's interesting because this stabilization is kind of layered over some pretty solid U.S. economic numbers.
Yeah, and maybe some real, though maybe fragile, easing in the U.S.-China trade picture. I saw China suspended its unreliable entity list.
That's a key point. We're definitely going to dig into that. And also the skepticism facing the administration's tariff policy back home, at the Supreme Court. Plus, we need to track oil, that classic battle of oversupply versus demand signals.
So you'll really get a sense of how investors are trying to balance these big strategic shifts, things like rare earth mining cooperation, Japan's involved there, but also these really complex geopolitical risks, denuclearization talks involving Moscow and Beijing. It's a lot.
And by the end, you should have a clearer picture, a framework really, to figure out if this stability we're seeing is, a genuine rebound starting, or if it's just the quiet before the storm.
Let's unpack it.
Okay, so the macro view first.
Right. The dollar seemed to take a breather after its best run in, over a month? Which is interesting because the data looked pretty strong. ADP, employment, ISM services,
Right.
It all screamed U.S. strength. So why isn't the dollar just, taking off?
It's a classic case, really, positioning. People squaring up before what they think is a policy shock coming.
Yeah.
The market had largely priced in that U.S. strength already, But the feeling now is just caution. Everyone's waiting.
Waiting for Fed speakers, but maybe more for the president's announcement today.
That's the big one, yeah. It could totally reset how people feel about risk globally. The strong U.S. economy is still the anchor, no doubt. But right now, traders seem more focused on what might happen with policy than the latest data point. So the dollar is just kind of stuck in a range.
So it's a policy ceiling driving things, maybe more than a data ceiling. And that solid economic picture is still there, even with the background noise about that government shutdown persisting.
Exactly. And we did see some strength elsewhere, too, which probably helped cap the dollar. The euro popped back above 1.15 for a bit on decent European PMI data.
Okay.
And the pound gained, too, just reflecting that slightly better mood overall, which links right into the biggest relief point.
Mm-hmm.
Trade, we're seeing some real, actual signs of de-escalation between the U.S. and China.
Let's talk about that de-escalation. You mentioned China suspending its unreliable entity list.
Yeah.
For listeners who aren't deep in trade mechanic, what does suspending that list actually do? What does it mean practically?
Well, it's a very concrete move. It's not just words. That list was basically China's retaliatory weapon, right? Threatening restrictions on foreign companies they felt harmed Chinese interests. So suspending it and also lifting restrictions on specific things like U.S. optical fiber products, it sends a clear signal to U.S. businesses. It says the immediate threat of some, arbitrary punishment has gone down significantly. It gives commerce a bit of breathing room.
Yeah.
That's why sentiment picked up.
And it wasn't just policy signals either, was it? China actually started buying U.S. farm goods again. Wheat, sorghum shipments confirmed for December. That's tangible stuff after months of real friction there.
It suggests a genuine tactical move, at least, to dial down the heat with Washington. But, and this is a big but, this progress runs straight into a serious challenge back here, domestically. The administration's trade power itself is being questioned.
You mean the Supreme Court hearing on the reciprocal tariff policy?
That's the one. It introduced a huge amount of uncertainty.
We heard the justices sounded pretty skeptical, but let's dig into the why. What's the legal basis the administration is using for this policy, and where's the weakness the court sees?
Okay, so they're leaning on the International Emergency Economic Powers Act, IEPA, from 1977. It gives the president really broad powers to regulate international commerce if there's an unusual and extraordinary threat, national security, foreign policy, the economy.
Right.
The vulnerability, what the justices seem to be poking at, is whether that law, which was mostly used for things like financial sanctions or responding to military threats, actually gives the president the power, unilaterally, to slap on trade tariffs.
Right.
Especially these reciprocal ones, just based on a general ongoing trade imbalance being called a threat.
So if the court rules against them and basically takes away that reciprocal tariff tool.
It pulls the rug out from under a big part of their leverage strategy with trading partners.
Yeah.
That uncertainty hangs really heavy, even with the positive news snippets on the China front.
It definitely complicates the picture.
And it raises a key question for you as an investor. If that core presidential tariff power gets weakened, what tools do they turn to instead? And we're seeing a possible answer emerge already in the strategic shift towards securing supply chains. Think critical minerals.
Ah, you're talking about the rare earth mining cooperation talks.
Precisely. Japan and the U.S. moving forward on talks about joint rare earth mining near Minamatory Island. Now, this isn't some quick financial play. This is deep structural national security policy.
Driven by necessity.
Absolutely. It's about securing those critical mineral supply chains, hedging against having too much concentration in one place, namely China. It shows countries are starting to prioritize resilience, maybe even over immediate cost savings.
Okay, moving from strategic minerals to energy. Let's look at oil. WTI is sort of hovering around $61 a barrel, but the tension under the surface feels pretty significant.
Oh, it is.
You've got this big build in U.S. crude stocks, over 5 million barrels, which screams oversupply. But then you have hints of stronger demand coming, partly because trade frictions might be easing. How does that balance out?
It's the ultimate standoff, isn't it? Supply-side moves versus the outlook for future demand. Look at Saudi Arabia. They're actively defending their market share in Asia. They cut their December official selling prices, their OSPs, to Asia by over $1.
Deliberately pushing supply, then.
Exactly. That deliberate pressure, combined with the inventory overhang, is what's keeping WTI kind of pinned down, even with some positive macro signals floating around.
Yet we're also seeing some structural support for demand pop up, right? Like Poland talking with the U.S. about buying more LNG, specifically to help out Ukraine and Slovakia.
That's a key trend to watch. It shows how geopolitics can create these underlying demand floors. That whole LNG shift is part of Europe's long-term, multi-year strategy to reduce reliance on Russian energy.
So that's not just about current market conditions.
Not at all. It's fundamental. It provides a kind of baseline support for non-Russian gas alternatives, even if current tanks are full. Meanwhile, gold's still consolidating, hasn't broken $4,000 yet, but copper's edging up. That's often seen as a bit of a risk-on signal, maybe reflecting Wall Street's recovery.
Which brings us neatly to geopolitics. And here, the picture looks anything but steady. We've got regional hotspots flaring up, Turkey's intelligence chief meeting with Hamas officials about ceasefire issues.
Right, while Israel is reaffirming it's ready for a full offensive if things escalate with Hezbollah. So tensions are high there.
But the really profound uncertainty, the high-stakes stuff, seems to involve the major nuclear powers.
Absolutely. President Trump confirmed the U.S. is working with China and Russia on some kind of denuclearization plan.
Yeah.
Trying to stabilize the global proliferation picture. On the surface, that sounds constructive, right?
Yeah.
Diplomatic progress.
But then almost immediately the Kremlin comes out and signals it's getting ready for potential nuclear tests if the U.S. restarts its own testing.
Yeah. President Putin ordered his ministries to draft proposals for test readiness. It's a textbook example of just how complex this diplomacy is and how quickly it can inject risk back into the market.
So even if they say they hope dialogue continues,
the very fact that a major nuclear power is formally preparing for tests introduces this deep, hard-to-quantify strategic uncertainty. For markets, that usually translates into a higher geopolitical risk premium. It hints at a potential move away from arms control frameworks that have been pretty stable for decades.
And then there's that signal from Belgium's defense minister saying their National Security Council will meet about invoking NATO Article 4 because of drone incursions near airports. What should people understand about the significance of Article 4?
Article 4 is serious business diplomatically. It's not Article 5, which is the collective defense trigger, but Article 4 is the consultation mechanism. It means a NATO member, Belgium in this case, feels that the territorial integrity, political independence, or security of any NATO member is threatened. The fact that the threat here seems to be non-state actors using drones near critical infrastructure. It highlights how security anxieties are shifting away from just traditional military threats towards these complex asymmetric challenges.
Wow. Okay, so if we tie all these threads, the trade moves, the court case, oil, the geopolitics, back to where we started, with the market holding steady.
You see why that stability feels so fragile. Asian stocks did rebound overnight. U.S. futures are looking firm this morning. Investors are clearly digesting the strong U.S. data, and they like the concrete trade gestures from China.
But they're pausing.
They're pausing right before a whole wave of directional policy announcements. Central banks are meeting today, Bank of England, Bank of Mexico, Norges Bank in Norway. all adding to that policy flurry, plus the president's announcement, plus that looming Supreme Court decision.
So that's the core issue for you, the listener, right now. We're kind of in this holding pattern. Solid economic fundamentals underneath, some tactical cooling on the trade front, but surrounded by potential policy shocks, big questions about presidential power from the courts, and these high-level geopolitical frictions that could easily ratchet up the risk.
Yeah, so what does this mean for your strategy? It feels like this current stability is probably less of a sustained market rebound starting, and maybe more like the calm before the next policy-driven wave hits. And maybe the thought to chew on is this. If U.S. trade authority does get significantly blunted by the Supreme Court, and maybe China's gestures are just tactical for now, who or what steps into that vacuum? Where does global market leverage come from next? Keep an eye on how fast nations might pivot capital towards building their own self-sufficiency in critical areas, like those rare earths we talked about.
Appreciate you tuning in for this essential framing of the market's delicate balance today.
Join us again on the Financial Source podcast for more insights.